recognize the gentleman from New Jersey for 5 minutes.
And I thank the Chairman for holding this important hearing today. I believe it is critical, as he says, that this subcommittee conduct proper oversight of the credit rating agencies and examine all of the issues surrounding the role that they played, if any, in the lead up to the nation's current situation. I'd like to thank all the witnesses for the panel attending. Unfortunately, we don't have a representative from the SEC. That's the government agency tasked with overseeing and regulating the NRSROs here with us to testify. And so I feel it's essential that before this committee does formally consider any regulatory reforms regarding the rating agencies, that we should at some point hear directly from the SEC as to what, if any, additional powers or changes they see necessary. Over the past decade, we have seen a large increase in the role that credit rating agencies have in determining the credit worthiness of financial institutions and different types of securities. Whether it is corporate, municipal, or structured finance, any entity seeking to assure investors of the quality of the debt must receive a good grade from one of these entities. And so investors have become increasingly and too often solely reliant on the use of these ratings in determining the safety and soundness of an investment. This situation, like many of the other problems of this financial crisis, has in large part been created by government policy itself. For in literally hundreds of federal and state government statutes and regulations, there are specific government requirements mandating certain grades from approved agencies. It is this formal requirement that provides an implicit stamp of approval, if you will, to the investors. When an investor sees that the government is required a specific grade to make a, quote, safe investment, well, basically reinforces the belief that any investment attaining such a grade is a safe investment. But to its credit, the SEC recognizes this problem as well, and they are moving to address it. So in December of last year, the SEC proposed several new rules, one of which would reduce the reliance on the NRSRO's ratings in the SEC's regulations. I believe it was Commissioner Casey who had it right when she said, these requirements have served to elevate NRSRO ratings to a status that does not reflect their actual purpose, much less the limitations of credit ratings. So Congress really should try to follow suit and re-examine all the areas where statutes mandate the ratings of NRSROs. Credit ratings are only one piece of the puzzle. I think we'll hear that from the panel in determining credit worthiness. Investors must be encouraged to do their own due diligence in evaluating issuer credit quality. Now, one of the other areas that needs to be addressed is increased competition within the industry. And I hear from the panel as well that they may be amenable to that as well. The 2006 Act made a number of significant improvements to the process. Unfortunately, the law was just beginning to be implemented at the time when the financial system started to hemorrhage. And the very worthwhile goals of the 2006 laws, as far as fostering more competition, enhancing transparency, and increasing accountability, may still be achieved. So two things I do not think Congress or the SEC should do to eliminate specific types of pay models or prescribe exact analytics that NRSROs must use. This would go against the intent of the legislation by providing a further reduction in competition and increasing investor reliance on the ratings. In regards to competition, a recent rule issued that also runs contrary to the goals of 2006 is from the Fed, when they have the requirement that any securities used as collateral in their term asset-backed lending facility, the TALF, must have an A1 rating from a major NRSRO. So this major NRSRO term is entirely new and refers to the big three rating agencies. While I assume that the Fed added this requirement due to the perceived better quality of the big three firms, I will remind the Fed that the big three rated Lehman's, unfortunately, as A1 on the day of bankruptcy. Another area in which I would like to see increased competition is the manner in which credit quality is determined. And I know that some of my friends on the committee would like to demonize credit default swaps as a horrific gambling bet made by fat cats smoking cigars and sitting in luxurious boardrooms. But the fact of the matter is, credit default swaps are actually additional measures of assessing the credit worthiness of different corporations or securities. And during the height of the financial panic and collapse of many major firms, credit default swaps provided a more accurate gauge of risk than some of the credit rating agencies. So in conclusion, Mr. Chairman, I believe that the government must continue to wean investors off being solely reliant on credit ratings and encourage them to conduct their own more due diligence. And I do greatly appreciate the Chairman holding this very important hearing and looking forward to all the witnesses' testimony today. Thank you.
Thank you very much, Mr. Garrett.